Today we will be talking on how different types of REITs in different markets like Singapore, Hong Kong, or Malaysia are performing so far ever since they got listed some 10 years ago. Okay, and we look at their performance, every one of them. Of course, those who have a listing record of at least 10 years. Okay, and of course, we also will look at the REITs outlook for this year, 2019. And I will give you my opinion on that. Some of you may know the answer. Okay, so and also share with you how interest is going to affect the REITs, especially now the Federal Reserve is going to increase the rate. Has been actually increasing the rate gradually. Okay, so and also which are the best type for REITs for you to look at. Okay, and of course you have question related to REITs, please type in the chat box and just send it to me, and I will try to answer as many as I can. Okay, because we only have 1 hour session, so you better make sure that you type your question first. At least I get a chance to see, because later the list will just go on get very, very long. Okay, so now okay, so usual disclaimer applies on whatever that I share with you tonight is only for educational purposes. Okay, so whatever that I share with you here is not a recommendation to buy or sell. Okay, and before I begins with the content, I just want to make an announcement, and because a lot of you has been asking me when are we going to launch dividend machine. Okay, when is the workshop coming up? Okay, and I have good news for all of you here. Okay, the dividend machine going to be open up next Monday. Okay, so if you guys are interested to join, you can actually sign up during the launch. Okay, so this will be the countdown timers. When you go to the website dividendmachines.com, you should be able to join really, really soon. Okay, so if you have friends who are interested in dividend machine, you can actually ask them to sign up during this time, because it will only be open for only period of time. Okay, so Boon Hao also asked whether is dividend machine only about REITs. No, REITs is actually half of the modules, and the other half will be, we are talking about normal income stocks. Okay, so all right, then I will just go through this article which I wrote, I think 2 years ago, where I started writing about the performance of REITs in Singapore. And as you from here, you get to see that the performance across different REITs in Singapore, they have a listing track record of at least 10 years. Okay, so like Ascenders, they listed in 2002, Ascot REITs listed in 2006, and the list goes on until we have Mercator Industrial REITs. Okay, so if you look at the table here, and this was written some 2 years back. Okay, the performance so far for all the REITs has been quite reasonable. In fact, I think Ascenders, Ascot, CDL, Parkway, FCT, First REIT, they all have actually delivered very good result. If you buy them since IPO and hold it until 2017, of course your performance is going to be quite amazing. Okay, at the high single digit. And of course, as you go down the list, there are REITs that actually screw up, like Lipo Mall because of the currency REITs, and then Alco REIT, stuff like that. All right, and of course, 2 years ever since I wrote the article, things have changed, especially interest rate. They actually changed quite significantly, because before that, interest rate were actually quite low, and Federal Reserve has been trying to increase the interest rate in 2018 and also 2019. Okay, so this is the interest rate back then. That was actually below 1%, and that was in 2017. Okay, so we are actually in the one of the era where the market, the world, get to enjoy the lowest interest rate for quite a long period of time, almost close to 10 years. Okay, you get to see from the chart here, since 2009 when the market crashed, Federal Reserve interest rate actually has been below 1%. Okay, and we have never seen this in our history, such a low interest rate. And recently, of course, as the economy continued to pick up, especially in the US, Federal Reserve are actually giving us hint that they're going to continue to increase the rate. Okay, and of course, at the time, 2017, when I did this webinar, the same thing when I go through the presentation, and those people who come to the workshop and ask me whether interest rate is going to affect the distributions that is being paid out by REITs. Of course, the answer is yes, it's going to affect the REITs if the height of the interest rate is sudden and it's not gradual. Like this is I would consider as gradual height. Okay, sudden jump of interest could be like a sharp rise and then suddenly go up even higher to 8%, 10%. Okay, so and of course, if it's a gradual type of height in terms of interest rate, and I think that time my answer was that the REIT should be able to cope really well, because during the period where in early 2004, 2005, 2006, 2007, when the economy was doing well, we get to see interest rate were actually going up. All right, and this is happening across many countries, and US are usually the country that actually Federal Reserve decide where the interest is going to be depending on the economic situation. Okay, so when US it raised the interest rate back in 2004 all the way to 2008, okay, the performance for REITs, all right, back in Singapore, okay, a lot of REITs are actually doing relatively well. Okay, so if you look at the REITs, this table here that's actually consolidated by Philip, right? And if you look at the share price performance in 2004, 5, 6, right? And this was a period where the hike was actually gradual. It has gone up all the way to 4 to 5% in terms of interest rate. And despite the higher interest rate, the REITs in terms of performance was still doing relatively well. Okay, so this is quite ironic because a lot of time when the interest rate goes up, a lot of people were expecting that REITs going to pay lower dividends because the REITs usually borrow money to invest in property. And because of that, the higher borrowing cost will cause the distribution per unit to drop. Okay, but this is not the case back in 2004, 2005, and 2006. Okay, and the main reasons for that was due to the fact that when the interest rate goes up, okay, of course, theoretically speaking, the distribution per unit should go down because interest cost is more expensive to borrow. It's more expensive to borrow money, and that will affect their income. Okay, but in the actual world where we live in, when economies goes up, okay, the interest rate goes up, usually is a sign that economy is doing well. When the economy is doing well, generally people are making more money, businesses are also making more money, and of course when everyone is making more money, the economy will start to expand, people will start to spend. When they go to the shopping, you know, and they spend their money on the retail shop outlets and all that, the earnings, the business owner, of course, they'll make more money, and of course they can afford to pay more rent, and then, of course, tourists will start to travel more because they're earning more money, and hospitality sector will get to boost. And from here, this chart, you get to see that these are the data that I think Philip actually has compiled, and I thought it was a very good data here. The retail rental for the properties actually has gone up. All right, you get to see here during the hike, and even for the office economy is doing well, businesses are doing well, they can afford to pay because they wanted to expand and they need more space for their offices. Of course, the demand for office space go up and the rental will also follow along the way. And you get to see that here, the rental actually gone up as well. Industrial also, businesses, industry, warehouses expand because more and more people are buying stuff. You know, business needs to stuff up the inventories and stuff like that. Okay, and also the same for hotel is also doing quite well. Okay, so rising interest rate doesn't necessarily means bad for REITs. Okay, this is the misconception that people have about the REITs, and that's the reason why some people say that they will not want to look at REITs because now interest rates are rising. Actually, that is a myth. Okay, when interest rates are rising, it's a sign that economy is doing well. By right, REITs should continue to follow. When the economy is doing well, there will be leads to actually asset inflation. Okay, so that's why when interest rate high, it's not necessarily means bad for the REITs. And that was my answer back then when 2017, there were a lot of concerns about whether should we look at REITs, you know, because interest rate is going to rise. Okay, and this is true because Federal Reserve in 2017, they said that they're going to increase the hike, but depending on the economy situation, but they actually estimate that they're going to increase to up to 2%. In fact, 2.7% over the next 2 years, so which is this year that we are talking about. And if you look at the actual implementation of Federal Reserve, and this seems to be quite true because if you look at the interest rate that Fed announced, you get to see here the interest rate actually has been rising here, and today we are talking about 2.4% as we do this tonight's webinar. And of course, as this interest rate continue to rise, the cost of borrowing will continue to increase as well. Okay, and that may affect the REITs. And of course, like I said, you know, when the economy is doing well, businesses may continue to do well, and the landlord may be able to pass down the rent. Okay, of course, this does not apply to all the sector. You need to look at every single sector and assess them accordingly. Okay, so but of course, when the rate, basically my answer is that the increment is actually gradual. I think it's okay. But if it's a sharp increment, like a sudden jump to 5%, 8% just within a year or 2 years, and of course, REIT is going to get affected really fast. Okay, but of course, there are some REITs that, you know, they have borrowing, all their loans are actually fixed instead of floating. Okay, so they may be fixed for a period of 4 years. So even the interest rate hikes, suddenly they may actually get shuttered for a period of time. Okay, so those are the REITs that you can actually look at, and they don't take on too much debt. All right, so don't get so worried about interest rate, because rising interest rate does not always mean bad for the REITs. Okay, and yeah, and this is always the question that people ask me, you know, what do you think would be the short and the long-term outlook for REITs, be it in Singapore or Malaysia or Hong Kong? And of course, my answer is that interest rate may continue to increase. Based on what we are seeing today, interest rate is likely going to increase. Okay, but I'm not so worried. As long as the increment of interest rate is actually on a gradual pace, maybe by the next year you had 3% to 3.4%, or not more than 4%. I think that's okay. All right. And of course, if you're concerned whether there will be a sudden high of interest rate, like I said, just look at those REITs that have lower gearing, less than 35%, and most of their loans are actually in the fixed period. Okay, so now let's look at the recent data that I've actually just compiled, and this is the latest one as of 31st January. Okay, and I did a new compilation again based on the dividends that they pay out, and the result that I'm showing you here today is, of course, the most updated one. You get to see here, a lot of REITs are still doing really well. Okay, so REITs are basically a living proof that, you know, we can actually invest for income. Of course, you must choose the right REITs, and yeah. So basically, you look at Ascendus, it's remained the top in the list. In terms of CAGR, is close to 10.6%. It's quite good track record actually, for investment to achieve a double-digit return. Parkway Life REITs also achieve close to 10% if you take into account the share price appreciation and also dividends that collected over the years. CDL close to 10%. FCT close to 9.6%. It's quite impressive. And it's definitely much better than the money that we put in the bank. Okay, so and of course along the way there are bad apples. Okay, so these are the REITs that you need to learn how to detect them early before they collapse. Okay, so we actually share all of this in the dividend machine. Of course, if you have a question, you can just feel free to ask now. I will answer them to you, but I just want to share it with you here. And one of the things that I want to highlight here is that first REITs used to be in the 6th position, and now the performance has dropped significantly because of the recent scandal, the corruption in Indonesia. Okay, and the market actually panicked and they sold down the share. Okay, and also there's a risk in the anchor tenants, especially Lipo. Okay, so I'm not going to go through in details on that, but if you have a question, you can feel free to ask. But so far, the performance of REITs in Singapore, I think, have done pretty well. Okay, so out of all the REITs that have listing record of 10 years, you get to see we have a lot of gains here in this table. Okay, so assuming if you bought all of them, your portfolio will do pretty well. Okay, and of course, next we will have Malaysia REITs. If you look at the Malaysia REITs, the performance are also pretty good. Okay, Axis REITs is one of the top highest performer since IPO in 2005 until 2019. The price has gone up. Okay, 172% appreciation, and the dividends that they have collected is 172%. Price is about 178. All right, so total return is about 250%, and that actually gave us a return of double digit, about 11%, and then followed by MRCB, which is actually office REITs in Malaysia, in UAE, and the list goes on. Okay, so Malaysia REITs doesn't seem to have bad apples. Okay, you have AM First REITs that actually share price have declined by almost half, but of course the dividends that they have paid out along the way has been quite substantial. Okay, REITs is well known to pay out almost everything of their earnings back to the unit holders. All right, so that's why distribution is going to be a big part of your return for REITs as a whole. Okay, so MREITs, I think the performance are even better than Singapore. Okay, and then next we look at the Hong Kong Hong Kong, those REITs have a listing record of at least 10 years. We have Link REITs, Sunlight, and then the list goes on. And the performance was pretty good. Okay, so Link REITs is actually the best performer in the whole REITs in Asia. Okay, so this is the best REITs ever listed. And it's pretty impressive. And look at the amount of asset enhancement initiative that the managers did, and the kind of value that they create for the shareholders is really very impressive. Okay, it's double-digit return, 18%. Okay, so just for your idea of 18%, Warren Buffett track record is 20%, and this REITs actually give a return of 18%, very close to what Buffett has achieved during his career in investing. Okay, of course, Link REITs is definitely much shorter. They started in 2005, but it's still very impressive return. All right, and Hong Kong also apparently did pretty well. Okay, it doesn't seem to have bad apples for those REITs that have listing history of 10 years. Right? Okay, so I mean there are some REITs that have done sour also, but it's not the focus of tonight. All right, so I've tried to allocate more time to answer most of your question later on. Okay, so I just want to cover some of the light contents at the start, and then I'll open. I will try to answer your question. All right, and next, of course, we're going to cover the valuation of the REITs across Singapore, Malaysia, and Hong Kong. And this is where we want to find out whether is it really a good time to invest in REITs in Singapore, Malaysia, or Hong Kong. Okay, I'm sure a lot of you are interested in this segment. Okay, so if you look at the REITs in Singapore, okay, here you get to see that the whole price to book of all the REITs that is listed in Singapore. All right, and this is price to book is basically price over book value. Okay, and anything that is above 1 is usually premium to the book, and anything that is below 1 is discount to the book. All right, and this is basically I took all the REITs that is listed in Singapore and plotted over a period of 20 years. So this data is really precious, and then I plot out the average price to book for the whole REITs, and this is to give us the indication on where the market value the REITs on the average, so-called fair value on a fair valuation level. Okay, and you get to see here, early 2006, 2007, when the market was very hot back then, the REITs were actually traded at a high valuation. It was expensive. When the market crashed in 08, 09, when everyone was panicked, they sold down the share, and a lot of REIT share price actually tumbled, and it actually gone down to the book value of the REITs that were actually traded as a whole. Okay, so this is where the big discount, and this is of course the best time to invest in REITs. And then the market started to recover back to the normal, okay, mean to reversion, reversion to the means, and then the share price had to go up again, and then it come back down again. This is back in 2011. All right, and 2012 during the Euro debt crisis, a lot of REITs actually tumbled again in share prices. Also another time to invest in REITs. Okay, as long as it's below the green line, it's good time to look at REITs. And as long as it's above the green line, is a good time to consider, looking out to sell out some of the REITs that you invested when you bought during the crisis. Okay, I mean, for those who are investing just for income, you can ignore the entry and exit if you are just buying REITs for income. But make sure that your entry point is, you're buying at a good price, basically at a discount, so that you get the best yield and best return here. Okay, so, and of course, and then goes on and on and on until we have 2015 when the China stock market burst. It affected Hang Seng and also Singapore Stock Exchange. The whole REITs index actually dropped. A lot of REITs that we were looking back then also dropped in share prices, and we started to buy them. And of course, and then recover all the way in 2018, recover. And last year was really a bad year for Asian market. And if you look at Shanghai Stock Exchange, Shenzhen, Hang Seng, it actually declined by almost a quarter, all right, which is 20 to 30%, and that was actually a sharp drop. And this kind of drop, usually we call it a mini crisis. If the drop is, let's say, 40%, 50%, these are what we call as major crisis, big crisis. Okay, so last year was a bad year for Asian market. I mean, I'm sure those of you who invested in the market, you look at the portfolio, some of the stock that you bought will probably in red. Okay, of course, you don't look at it today, you look at it last year, a year ago. Okay, and because of that, if you look at the REITs price to book as a whole, a lot of REITs were actually being sold down from the high above the green line and being sold down all the way to the discounted price. And of course, this was again the good time to look at the REITs back then. Okay, and today, of course, as we record this video, the prices of REITs as a whole has actually started to go back close to the fair valuation. This is the line here. Okay, and if you ask me whether REITs is expensive or not today, I would say that it's fairly valued. Okay, if you just look at this chart, you have your own answer. The next time when I present to you and the chart showing you that this price to book of the whole REITs is actually significantly below the line, then obviously that is really a good time to look at REITs. Okay, if it's fair value, there are still opportunities around. We can actually start to look at some of the companies or REITs or some sectors that may be trading at a discount. Okay, and if it goes up above the line, obviously it's expensive like this. You may want to consider selling if you want to time the entry and exit. Okay, so like for now, I'm actually looking closely at the office sector, because office sector in Singapore seems to have steady recovery, because the supply for office space in Singapore has actually come down quite significantly, because in 2017 that was one of the year where there was actually a lot of supply of office grade A offices coming to the market in Singapore, and that actually caused the rental for grade A offices to come down. Okay, and of course, moving to 2019, 2020, 2021, the supply for office space actually come down, okay, to about 0.9 million square feet that's going to come online each year. Okay, so this is forecasted. Of course, the number may change as we move down the road, but as a whole, I think the supply for the office market in Singapore has actually eased off. And of course, if you look at the CBRE research, they actually says that the vacancy rates have actually gone up. So-called the occupancy rate for the office sector as a whole has actually gone up to 94.8% here. Okay, what this means is that if the occupancy is started to go above 95% as a whole for office market, and this is exactly the time where a lot of office landlord like CapitaLand, Commercial Trust, or Keppel, they may start to be able to charge higher rent. Okay, when they start to charge higher rent, of course, unit holders will be able to enjoy increasing distribution per unit. Okay, if the recovery takes place and the economy continue to do well. Okay, and this is the price, the rental for office market now for grade A office. On average, the rent is about 10.80 per square foot. Okay, so it used to be as high as $18 per square foot, and then it come back all the way down when the market crashed to $8. And then because of the market was quite soft over the last 5 to 8 years, the rental actually is trading between $8 to $11. And now today we are at a 10.80. Okay, so I think the recovery is actually taking place for the office market. So I'm actually watching closely, but I haven't seen any opportunity yet, because the share price for the REITs market as a whole have actually recovered. So I think if office market, let's say, gone through corrections and the economy continue to remain where it is today, maybe we can look at office market. Right, and one of the things to take note of is, of course, the average rent that is going to expire for the office REITs itself. Okay, so like in this case, CapitaLand Commercial Trust is the office REITs that own a lot of grade A offices in Singapore, like Capital Tower. Now, those are prime assets. The average rent that is going to expire in 2019, basically those are leases that are going to expire in 2019. They actually signed the rent at an average price of $10.46 PSF. Okay, and today the market rent is about $10.80. Okay, if the market continue to recover, let's say goes above $11 or $12, when they renew this rent, the shareholders, of course, will benefit from the positive rental reversion. Okay, so this is where the growth in terms of DPU will start to kick in if the market rent remains where it is. Okay, of course, we can't predict where the market rent is going to be next year or 2 years down the road. We can only find out what is the supply going to be over the next 2 to 3 years, and that is where, just now I give it to you, the supply will be quite moderate. Okay, as long as the economy don't go into deep recession or crisis, I think the rent for office should continue to hold up very well or improve. Okay, and 2020, the average rent that's going to expire is below $10, even better. Okay, basically there will be a more sharper positive rent reversion, and of course 2021 there will be a slightly higher. Okay, so it depends on where the market is heading. So if we continue to go up to $12, $13, I think this will benefit office sector as a whole. Okay, and that's why I'm watching this closely. Okay, so that's for office. Of course, you have other REITs like Frasers and Commercial Trust. Those are office REITs, Capital REIT. Manulife REITs is slightly different because they are US REITs. They own office asset, and office asset in US is the landscape is really very different because they go through those long contract leases of at least 10 years, 15 years. All right, so it's really long. Or you commercials, okay, so and then you have Suntec REITs that are actually exposed to office REITs. So you can start to look at all these REITs. Of course, I'm not seeing any opportunities yet. I'm just monitoring the opportunities. Okay, because generally as a whole, the REITs have recovered in Singapore. Okay, so there's still some opportunities around. So you just have to look harder. Right, and next, of course, for Malaysia, Malaysia's, if you look at the average price to book is around 1 times. And here you get to see Malaysia go through the same patterns as what we have seen in Singapore. All right, and of course, back in 2007, there was only one REITs that were listed. That's actually AHP. Okay, so we're going to ignore that because the data is only one company or one REIT. And then we have more REITs listed along the way: Axis REIT, CMMT, and then after the market go into recession, and then go back up again, premium, and then go back up, down, and then up again, down. Okay, so 2017 when we started to cover Malaysia REITs, we were so shocked that the Malaysia REITs were trading at a very expensive valuation, and the yield that the average yield that the Malaysian REITs are giving is actually lower than what we are getting in Singapore. Okay, so that actually doesn't make sense to invest in Malaysia REITs. Even today, last year, if you ask me in 2018, of course, Malaysia market was really attractive because the price has came down to close to fair valuation. Okay, so there were opportunities which we actually invested, and of course today the market has recovered back again. So today the REITs in Malaysia is not cheap. I would not invest, right? And it's harder to find opportunities now in REITs in Malaysia. Okay, and this is for Malaysia market. And of course, next will be Hong Kong. And Hong Kong have a very limited choices there because so far the number of listed REITs in Hong Kong is only like, if I remember correctly, it's actually less than 10. So there isn't much choice for you to choose. Okay, so and Hong Kong REITs has been trading at a discount for a long time, mainly because the assets that were listed in Hong Kong Stock Exchange, the properties there were valued at a very low cap rate. Basically, the properties are valued at an expensive valuation. That's why the market actually pricing them at a discount. Okay, and you're seeing a less than about, on average, is about 0.9. Right, so the discount is usually the market will give them is at least 10% or 20%. Okay, so yeah, so Hong Kong has a very limited choice for REITs. Okay, so of course, if you are interested to find out what are the REITs that are listed in Hong Kong, Malaysia, or Singapore, you can just go to our website, fifthperson.com, and then there's this tab called REITs data, or you can just go straight to this sreits.fifthperson.com, and you get to see all the REITs that is actually listed in Singapore Stock Exchange, and you can actually go through the list and find out which REITs you are actually interested to analyze, right? And of course, if you are interested in Malaysia, just click on the tab, all right? And if you're interested in Hong Kong, it will bring you to the page here. Okay, but of course, when you analyze the REITs, you must know how to analyze and what to look out for them. Okay, and of course, those of you who have attended the dividend machine, you can just use the checklist, the REIT checklist, to help you with your analysis. And then for those of you who have not joined dividend machine, this is going to be a good time. Coming Monday, okay, you can actually start to sign up for a dividend machine. Okay, so and yeah, so now I just want to handle some of the questions that you guys have in mind. Okay, and then I'll just try to answer them here. Okay, so the first question, if you have questions, please feel free to ask. Okay, and keep them coming, and I will try to answer them. Okay, so the first questions come from Bun Hao. Bun Hao is asking me how many REITs or percentage should be in his portfolio. Okay, because he also invests in deep value stock, and he's wondering how many percentage or how can he combine the deep value stock with the REIT? Okay, so for now, I think my answer to you is there's no right or wrong percentage on how many percent you should invest in REITs or deep value stock, but I would say that you should not put all your money in REITs. Okay, I think that's a big mistake that a lot of people do. So I believe you won't go into that. But in terms of percentage, if you are good at deep value stock, maybe you may want to put a higher percentage, let's say 30%, 40% into deep value stock. Okay, and also depend on how old you are. Okay, I don't know how old you are. I hope you're young. Okay, so if you are young, for example, 30 years old, you can put a larger percentage in, growth stock or value growth stock, and then a smaller percentage, maybe 30 to 40% into income stock. Okay, so REITs is, I will consider them as income stock. And of course, you depend on which one you are really good at. If you are just good at deep value strategy, then you can focus fully on deep value strategy. If you want passive income that have a yield range of at least 5%, 6%, 7%, 8%, if you keep them long enough, you can actually achieve a 10% yield on a year-to-year basis. You can have a larger percentage for your income stock. Okay, so it really depends on your age. And of course, then next will come, I hope I answer your question. If not, you can feel free to ask. Okay, and I just compiled some of the questions that already been asked or also commonly asked here. I'll just try to answer them, and then I will come back to some of your questions that you guys have also. All right, and now this is the common questions that we always get asked. Is there an impact on REITs given that the recent trade war that's actually happening in the market? Of course, the impact, I cannot see any impact actually affecting the REITs in Singapore, because all this trade war actually affected a lot of exporter into the US and Chinese market, and between these two countries, of course, there will be a lot of tax that's actually being introduced. So REITs, I think, has nothing to do with this. Of course, the sentiments on the market has actually came down because of the recent trade war, and that may affect the spending on the economy as a whole. Okay, so but the impact is very limited, based on the stocks, the REITs that we actually invested in my portfolio. I think there is really very little impact on that. I think the biggest impact is more on the concern on whether the interest rate is going to continue to increase, okay, which I already answered to you earlier on. Okay, how about the REITs that have overseas assets, let's say in China and the US, REITs like Manulife REITs, and then you have Capital Retail China Trust that owns Chinese asset in China. And I think those assets are basically based in locally. They earn rental in the local market. So the recent trade war also doesn't really affect them. But bear in mind that if you invest in any REITs that have overseas assets, you have the risk of the currency risk, okay? Because if renminbi continue to depreciate against Sing dollars, then against Sing dollar, then you're going to have a lower distribution per unit. Likewise for REITs that have asset in Australia, London. Again, more and more REITs are actually going to London market. Okay, so I think the impact for this is very minimal. Okay, so and then Bun Long basically asked, should we focus on REITs with higher yield or REITs with lower consistent yield? Quick answer to your question is lower yield REITs that give you consistent and growing distribution per unit. That would be the best REITs to own, and not those that have a higher yield. Let's say like 8, 9%, 10%. I remember 2 years ago, Savannah was trading at 12% yield, and if you were invested in Savannah back then, just mainly based on yield, you hold it until today, the price would have been half. Okay, you have lost half of your money. So even in the dividends that you collected, you will not be able to cover back the capital loss that you have made over the last 2 to 3 years. Okay, so because Savannah subsequently reduced their distribution per unit by I think 10, 20, 30%, that's why the share price came down. Okay, so don't get attracted by those REITs that have higher yield. Okay, so you need to find those quality REITs that own quality asset that actually located in the prime area, that have good tenants that will continue to pay the rent, be it good time and bad time, and the malls, for example, will continue to have traffic in good time and bad time, and the managers are actively enhancing the value of the asset so that they can charge more rent to the landlord because they bring in more traffic to the assets. Okay, so these are the REITs that you should look at. Okay, so and Chris asks, I'll come back to you, Boon Long, if you have I think more question, but I just want to answer Chris' question. Chris basically asks, REITs borrow money to invest in property. How does it work when a REITs like Starry Global in a particular year, let's say 2020, has a big amount of loan that is going to be expected to be repaid? Okay, is it always the case where the REITs, okay, sorry, I lost it. Is it always the case where the risk managers will somehow always get the loan refinanced, or they will be able to get the money to pay off the loan? Okay, I'm asking this in the normal economic situations. I know before the AIMS Capital took over, the previous managers screwed up badly and they could not repay the loan, especially during the global financial crisis. Okay, so Chris, very good question. Basically, REITs in Singapore, not just in Singapore, I think anywhere else in the world, they don't usually pay back their debt. Okay, they have to roll over. Usually, when the REITs take on debt, they will, let's say they borrow 100 million from DBS, for example, and DBS will give them a loan period of, let's say, 5 years. So when the loans mature in 5 years' time, of course, the REITs will have to go back to DBS again and ask them whether DBS will let them to refinance the debt. Basically, they borrow again 100 million, and then they'll pay the interest at a point of time. Okay, if DBS say no, of course the REITs will have to find, let's say UOB say no, they will have to go to OCBC say no, then that is what happened to AIMS AMP, and this is the previous REITs is actually known as Mercator Industrial REITs, where they could not be able to refinance the loan because when the crisis took place, the liquidities in the market actually dries up, so they couldn't refinance the debt, and they were actually being forced to sell some of the assets. And of course, during the crisis, it was very difficult to sell the assets, and usually the asset will also be sold at a very distressed price. Okay, so the managers ended up looking for a white knight, and that white knight is actually, his name is called George Wang, and he came in and he did significantly buy the shares of the REITs at a huge discount. Okay, and a lot of shareholders actually lose money in that stock. Okay, and of course, this is really back to the managers. How prudent are they when it comes to borrowing money for the unit holders? Okay, so some REIT managers, like the previous managers of Mercator Industrial REITs, were very, very aggressive. They borrowed a lot of money to actually buy industrial assets. And of course, when the time is good, money is everywhere. Okay, so it's easy to borrow money. And when they took over, I think the gearing ratio back for this REIT was actually at above 40%. Okay, so that when crisis happens, and that actually affected them, and the REIT was actually very small, so they don't have a sponsor, and they do have a sponsor, but the sponsor wasn't very strong, and the sponsor couldn't come in and help them, and that's why MSMP actually got affected really badly. Okay, so usually when we approach to finding REITs to invest in our portfolio, we look at REITs that have prudent when it comes to managing their capital. They don't borrow too much money. They have a gearing ratio of less than 40%. They have a high interest coverage. A lot of their loans are fixed. Okay, and they don't just rely on one source of loan. They have a multiple source of loans. Okay, that they can refinance and renew. And of course, they must have a good sponsor. Okay, so when you have a sponsor like, let's say, Capital Mall Trust, like CapitaLand. Okay, so when a crisis happens, Capital Mall Trust can go to CapitaLand to borrow money, or they just go to the bank and tell them that the sponsor of this REIT is CapitaLand. And who owns CapitaLand? Temasek, okay, Singapore government, and that's really very strong, very, very strong. Okay, and that's how you should approach on how to find a good REITs to invest for your portfolio. Okay, so avoid those companies that are really very small, they don't have a good sponsor, they took on too much debt. Avoid those REITs. Okay, so I hope I answered your question, Chris. And Hong Che, okay, you asked, would you recommend REITs with majority of properties overseas but listed in Singapore? Yes and no. It depends on the REITs itself and the assets that they own. Okay, so for REITs, I think I pay a lot of attention to the quality of assets that they own. If those assets that the REITs own are high grade assets, okay, they have good tenants, they're located in a good location, they have a long lease structure, maybe 10 years, that has a built-in rent escalation on a year-to-year basis, I may consider those REITs, okay? So the answer it really depends. This is quite generic, but the answer is basically yes, okay? But depends on what type of REITs that you're talking about, okay? So, okay, now I have really a lot of questions, so I'll try to answer a lot of your question. Okay, I will just take turn. I'll come back some of your question later on. Chris, I will come back again if I have time later, but I will just go through SW asking, is it still a good time to enter into REITs now with current valuation? Well, I wish that I conducted this webinar last year. I would tell you straight away, yes, it's really a good time to look at REITs now. But for now, the share price has recovered quite a bit. I would not say expensive, but it's fairly value. If you are happy with some of the REITs, good quality REITs, the yield that they're paying maybe 5%, and they can continue to grow their distribution per unit, I think those are the REITs you can consider. And you don't have to put all your money straight away. Okay, you can deploy, break down your deployment into 3 tranches. You can start to buy first tranches first while waiting for the corrections to happen. Okay, if not, it's okay. You can just sit on cash and continue to wait for the next cycle, because REITs are actually volatile in a way that sometimes when the interest rate hikes, the market will panic, they will sell down, the share price will drop, and the yield become high again, and that's exactly the time you can look at it again. Okay, I mean, in dividend machine, we teach you all this, so you should be able to know, when is a good time to buy and sell. Okay, so for now, it's fairly value. There are opportunities around, just that you need to be more, don't be too offensive in your deployment. Okay, you only deploy when you see very clear opportunities, but keep cash. Okay, and then okay, so then you have James Paul asking, will REITs go into insolvency? And of course, the answer is yes. I think just now Chris has asked me about the ability for risk manager to refinance the debt. Okay, if they could not find someone to help them to refinance the debt, then of course they will go into insolvency, or the management do not know how to manage the asset well. They don't know how to attract good tenants. They don't know how to manage, how to do asset enhancement initiative. They do not know how to buy good property. Of course, the REITs will be in trouble. Okay, so these are the criteria that we need to, analyze before we qualify a REIT. Okay. Okay, David have an interesting question. Okay, and this is specifically to a REIT. Okay, and this REIT is first REIT. Which means, what do you think of first REIT? Okay, so first REIT is a healthcare REITs. For those of you who are not familiar with REITs, they are not the first REITs to list in Singapore, but basically they are healthcare hospital operators that owns healthcare assets in Indonesia. Okay, if you've been to Indonesia, I'm sure you have heard some of this hospital brand called Siloam. Siloam is very well known in Indonesia. I'm Indonesian myself, and they have a lot of hospitals all over in Indonesia. Okay, so first REITs basically they own the assets, and they lease out these assets, some of the hospitals, to the Siloam to run their hospital, to run their business, right? And then they will just collect the rental in Singapore dollars. Okay, and so there isn't any currency risk for first REITs because they collect their rent in Sing dollar. Okay, despite the fact that their assets are mainly in Indonesia. Okay, but there is a risk for first REITs. Okay, and the risk for first REITs is the anchor tenant risk. Okay, the counterparty risk. Will Siloam continue to pay the rent in Sing dollar? Okay, and apparently if you go and analyze first REITs, right, look at the details, the annual report, the prospectus, you will find out that Siloam Hospital is actually paying the rental to Lippo. Lippo is basically the sponsor of first REITs. Okay, they are owned by Riyadi family, a very rich tycoon in Indonesia. They actually rent the space from Lippo. Okay, in rupiah. So they are paying a local rental rate in Indonesia on rupiah currency. Okay, and then Lippo will lease the property from first REITs in Sing dollar. Okay, so you guys see the point, the picture here. Okay, and because of that transaction, Lippo is essentially subsidizing the rent for Siloam Hospital. Because if you look at the first REIT annual report, if I remember correctly, I think Siloam was paying about 20 million a year in rental if I convert into the local currency in Sing dollars. Lippo is actually paying first REITs about 19 million. So there was actually a huge subsidy of 70 millions a year. Okay, whether Lippo will continue to subsidize the rent when the master lease renew. The first master lease is going to renew, I think expire in 20 to 2021. Okay, whether they will continue to subsidize, that is a question mark. There is a risk that if you are investor of first REITs, you need to be aware. If you're considering first REIT also, you need to be aware. Okay, for me, I want to be safe because I don't think the subsidy, the way that the sponsor subsidize the rent is not a really good approach to invest in this particular REIT. Okay, so you need to be cautious on that. All right, but that's just my opinion. You need to do your own due diligence. Okay, so don't get influenced by me. Of course, then next we have, okay, maybe let me turn on myself so at least you guys get to see me. You know, you have something to see, right, rather than just slides. All right, will this be better for you guys? Okay, all right, so yeah, and then next I will just go on with other questions. Okay, Caroline asks, how do you evaluate sponsor behind the REITs? Okay, so the sponsor behind the REITs are usually those that have big stake in the REITs. Okay, so you can just go to the annual report of the REITs. You go to the last few pages of the annual report. There's this statistic of shareholdings, and usually the first one and the second one, the name of the bigger shareholders is usually the sponsor. Okay, so you can go and find out, download the annual report from SGX. If you are investing in Malaysia REITs, of course, you can go to download Malaysia REITs. And yeah, and sometimes the name itself is very obvious. You can know the sponsor, like Capital Retail China Trust. Who is the sponsor? CapitaLand. Okay, so, and then Mapletree Logistic Trust. Who is the sponsor? Mapletree. Okay, so sometimes it's very straightforward, but other times you need to go and find out who is, like first REIT. Actually, the name doesn't say anything until you have to go and find out. The bigger shareholder is actually Lippo, and Lippo is actually the sponsor. Okay, so yeah, all this is covered in the dividend machines, and of course, Jerry, wow, you guys really have a lot of questions, huh? Okay, but those are really good questions. Okay, so Jerry asks, Malaysian banks do well and pay good dividends. So how do you see bank as an income stock as compared to REITs? Okay, so for banks, really quite different. Today we are just covering on REITs, but I just do a quick answer to the bank. Bank are actually a unique animal. You need to look at it very differently. Even for the way you look at REITs will be very different when you look at bank, because bank you need to look at their net interest margin, you know, capital adequacy ratio and stuff like that. So I can't just give you answer straight away in this 1 hour short webinar. Okay, and I'm also not expert in this industry, but bank generally in Singapore, I'm not sure about the Malaysian bank, but in Singapore, because Singapore is a financial hub, okay, government are very strict and they actually impose a lot of rules that the bank cannot take on the risks. You know, they cannot invest in property. You know, they need to have a certain capital in their account so that they will not suffer a bank run and stuff like that. That's why bank in Singapore generally, like UOB, OCBC, DBS, are generally quite safe because of the strict regulations that we have here in Singapore. Okay, I'm not sure about bank in Malaysia because each country have their own regulations. So, but so far Singapore, I think is quite safe. Okay, and the way to look at them is really very different. And it's going to take me along another 1 hour or so to explain that. Okay, so I hope to answer your question, Jerry. All right. Okay, so Sean asks, instead of REITs, how about property stocks like Fraser Property, or CapitaLand? Are they worth a look? if we are investing for passive income. If you ask me, if those are basically the property developers, and those property developers, if are just the property developers itself, I think it's better not to invest in them for income, because property developers are very cyclical. When the property markets are doing well, developer will make a lot of money. When the property markets is down, they will lose money, and they will actually cut the dividends. Okay, so but for those property developers, like you mentioned about, Fraser's Property Trust, I think a bulk of their earnings are actually coming from the REITs that they manage. They are also REITs managers, and a lot of them are actually investment properties. Of course, those REITs, those property developers, you can consider them as an income stock if they pay stable dividends. Okay, but you just need to be cautious for Fraser Property, because their debt has been actually increasing, so you need to monitor quite closely. Okay, so likewise for CapitaLand, you need to look at the amount asset investment property that they have. Okay, but generally for property developers like CapitaLand, the yields are actually lower. Okay, so if you ask me between REITs or property developer, I will go for REITs, because the yield we are talking about at least 5%, 6%, sometimes can get 7%. Property developer, you're talking about 3%, 2%. Okay, usually they keep a lot of the capital to buy the land again, redevelop. So they don't usually pay out 100% like what REITs does. Okay, so I hope I answered your question, Sean. And okay, so Kelvin asks, from the overall REITs valuation in Singapore, is it a good time to invest in REITs? Which I actually answered now. Okay, so I will not come back again. Okay, so okay. Then Raymond asks, what Manulife REITs is US based? Is the DPU subjected to US 30% dividend withholding tax? Okay, this is a very good question, Raymond. Manulife REITs, if you look at last year, the share price has came down quite significantly, because there is actually rumors saying that the US government could impose the tax to them 30%, because currently Manulife REITs and other REITs like Keppel, KBS, they are not paying the 30% withholding tax. They do a creative way of doing legally through a structure where it allows them to, so-called avoid the tax. Okay, in a legal, it's a legal way of doing it. Okay, so they actually instead of investing the property in US from Singapore holdings, they actually lend the money to the US companies, and then the US company will invest in the property there, so that you will not subject to the dividend tax. And then when they collected the rental, they will pay the interest back to the Singapore Disco. So it's not considered a tax, right? So that's how they actually so-called reduce the 30% dividend tax. Okay, so now of course the risk is whether the government is going to impose the 30% tax on them, because a lot of companies, not just Manulife, Keppel, KBS, a lot of some fund management business also, they are using these unit structures that they have legally. Okay, but if the government come in and decide, we won't know what Trump is going to do next move, right? Sometimes it's going to be quite crazy. So that will be the risk for Manulife REITs, but the answer is basically they are not paying the 30% dividend tax for now. Okay, so and okay. Tony asks, how important is the sponsor to the REITs? Sponsors is very important. This is a really good question, so I want to take some time to answer this question. Sponsor basically have two very important roles. Okay, first is that if you have a good sponsor, they can develop. Let's say the REIT itself is a mall REIT. Okay, so a good sponsor can develop a new malls. When the mall stabilize, they can actually inject this mall into the REITs. Okay, of course, a lot of time people say that they inject at a high valuation, but this is not true, because I look at some of the REITs that they injected into the REITs, and so far they have done pretty well. Okay, so it's not true that a lot of REITs are just a place for the property developers to dump the assets, lousy assets. It's not true. Okay, so sponsor role is they can help to supply the pipeline of assets for the REITs. Okay, so the REITs will have the growth, for the future. Okay, so the managers don't have to find very hard to find opportunity, because when they go out try to find investment opportunities in the property market, it's very hard to get a good deal. Okay, so having a good sponsor that give them a list of malls that they can inject in the future, which is a good thing. It could be office, it could be hotel and stuff like that. And second thing is, of course, the role of the sponsor is they can come in when the REITs are in trouble, or they can, if you're a good sponsor brand, when the REITs go and negotiate for deals, people will credit your brand, okay, because you have a strong sponsor. They know that you're a serious buyer. You can find opportunity. And the second thing, of course, you can have a better cost of financing because you leverage on the sponsor brand. Okay, so having a good sponsor is really very important. Okay, that's why when we look at the REITs, okay, at Dividend Machine, we also look at REITs that have a strong sponsor. Okay, and okay, so we have a lot of ratio. Okay, Melvin asks, what is the ideal gearing ratio a REIT should maintain? Okay, so there's actually a regulation in place that MS set. Okay, in Singapore, the REITs are not allowed to borrow more than 45%. In Malaysia, the REITs are not allowed to borrow more than 50%. Okay, but personally, I'm comfortable with only REITs that have gearing ratio of less than 40%. Okay, and that is something that to take note of. Okay, so we still have question. Okay, and then Darren asks, is there a conflict of interest for Ascenders and Capital Land REITs after the merger? Should we wait for them to consolidate first before buying them? Okay, this is a big merger that actually happens between Ascenders and Capital Land. And I think the mergers between these two companies, I mean, both of these companies have a very good track record, and the REITs that they manage have done pretty well. So I think after these two companies merge, I don't see things going to change that much, because every REITs have their own board of directors they're going to continue to manage. And in fact, there should be more opportunity because these two REITs are successful in their own market. Now they have more resources to look at more market, look at more opportunities, look at tap on the more talents that they have within the two companies. Okay, so I think the REITs will not be affected as a whole, but if you're investing in Capital Land, of course you need to assess whether the merger is going to be accretive, not just in the short term, but over the mid to long term. Okay, but these two are good brands. I think the mergers generally, if you ask me, without looking at the details, I think the mergers are really quite should be synergistic for Ascenders and Capital Land. Okay, but the REITs itself, you need to assess them individually. I don't think it's going to get affected by the merger and merger. Okay. Okay, so okay, some of you ask, what REITs in your watch list? Which REITs do you recommend? Okay, I'm going to skip those questions because this webinar is basically a session for you to learn, not to get stock tips. I mean, if you want stock tips, you can come to Dividend Machine and you get to learn how to find those REITs yourself. Okay, because once you know how to analyze the REITs, it's very easy to make a decision. You don't even need to rely on me to make a decision. Okay, so I encourage you to do your own homework. I can't just say the name here because behind any REITs that I mentioned here, there is analysis that I need to walk through with you, make sure you understand the REIT before you invest. Okay, it's very dangerous just to tell you the name of the REITs and then you go and invest. All right. Okay, so then you have conservative investors. How do you evaluate the future growth prospect of the REITs? Okay, that is also a very good question. When we invest in the REITs, we do not want just the REITs continue to pay us the same dividends. In REITs, we call it distribution per unit. Of course, there are a few ways you can look at the growth prospect of the REITs. Of course, one way is, which is the most common one, acquisition. Those managers that are buying the new properties, are they buying yield accretive acquisition? So this is a really important consideration to take note of. And you need to be able to calculate the net property yield. And need to assess whether the acquisition group is accretive, not just DPU accretive, but also NPR accretive. And of course, you also can look at those REITs managers. Are they active in managing the assets, like doing asset enhancement initiative and stuff like that? Okay, so another ways also you can look at it is, of course, look at the cycle. All right, and sometimes if you know how to study the cycles of the property in office or industrial or hospitality. Sometimes by knowing the cycle, buying them at the bottom, you get to ride on the growth as well. Okay, so these are just some of the avenue that you can look at for REITs if you are looking at see whether they have these characteristics in place. Okay. Okay, so many questions. All right, and we still have, okay, I will just try to answer 3 more questions. Now we are at 9:01. Okay, so 3 more questions, and then we shall call it a night. Okay, so tonight is Valentine's Day. Okay, let me pick a good one. Okay. All right, Mr. Lim. Mr. Lim asks, I heard REITs can issue perpetual securities, which is not treated as a debt. Does this allow REITs to skirt off the debt to gearing ratio limited the ratio? Basically, Mr. Lim asked a really good question, right? So that's why I want to pick this question, because nowadays a lot of REITs, I think a few of them actually started to issue these perpetual securities. Perpetual securities is basically an instrument where retail investors like you and me can, or institutional investor can buy, and then the REITs will promise us a certain coupon rate, let's say 5% a year. But because it's perpetual securities, there is no maturity date for the debt to expire. Okay, and the REITs can technically, borrow this money for 10 years, 20 years without repaying back the debt. Okay, that's why they call it as perpetual securities. And because it's perpetual, they have to classify under equity. Okay, and when they classify under equity, when it comes to calculation of gearing ratio, basically total debt over total assets, the REITs don't have to take perpetual securities into account. Okay, so Mr. Lehman pointed out actually a very good point. If you find the REITs like, I think Lipomo, First REITs, they have perpetual securities, you need to add these perpetual securities into the gearing ratio. Okay, I mean, the REITs can tell you they have a gearing ratio of, let's say, 39%, but when you add these perpetual securities in, it's actually 43%. Okay, so some REITs are using this instrument or a way for them to avoid the debt gearing ratio, to actually keep the gearing ratio low. Personally, I look at the balance sheet of the REITs and actually remove this out. Okay, basically I include that in the gearing ratio so that I want to be conservative. Okay, so thank you so much, Mr. Lim, for asking this question. And okay, so then there's, okay, let me see. What is the ideal? Okay, some of you are wondering how I type the response. Okay, we have a team, supporting you. Some of the questions that you have. Okay, so I'm not the one that's typing. Okay, so let me pick another good question. Okay, SW asks, for dividend machine, is there a discount extended to loyal and returning members for investment quadrants and Alpha Lab members? SW, good question. Now, if you join before the closing date, you get to enjoy $50 off. Okay, this actually applies to you. Okay, so when we opens up next Monday, you can actually come in. Right, so that will be a really good special rate, because we may not keep this rate again when we relaunch it in the future. All right, so join as soon as you can, okay, and then come for the workshop. All right, so that is for SW. And okay, then Siva asks, what is the difference between NAV and book value? Okay, so basically they are the same, right? Just different terminology. Okay, so because this is a simple question, I'm just going to move on to one more last questions. Or last 2 questions before we end this off, since we still have some time. If you guys don't mind staying, okay, let me know. Then I can extend slightly longer. All right, so okay, so I have more questions here. Okay, Yuan asks how much money to set aside for possible right issuance for each REIT. Okay, so this is a really good question, because sometimes when you invest in the REITs, and the REITs manager decided to grow their assets, and they decided to call for more equity. Basically, they issue rights, or they may have placement or preferential offerings, And there's a time where you need to come up money and subscribe to the REITs. Okay, especially the REITs are those that you need to subscribe. If you don't subscribe to them, you may get diluted. Okay, so how much money should you set aside? Usually, the call for the capital usually should not be more than double. Usually should be around the size of money that you invested in the REITs. Okay, even let's say the REIT issue 1-for-1, then you're gonna have, let's say you invested 10,000, maybe they call for capital for another 5,000. Of course, then you need to set aside. Okay, as a portfolio, usually we will try to keep 20% of our portfolio in cash. So this 20% cash will come in very handy if one of the REITs that you invested decided to issue REITs, and then you can actually get a chance to subscribe to the REITs. Okay, but personally, I like to invest only in REITs that don't issue REITs. Okay, I don't like REITs that actually issue REITs because it can be very dilutive, especially if you don't subscribe to them. Okay, so I will try to avoid those REITs that tend to issue a lot of REITs issuance, and if you look at the track record, it's really very, very bad. Okay, so but still, you still need to have some cash that's set aside. 20% at least of your portfolio in cash. I think that's actually good enough for you to take opportunity when the REITs take place. Okay, so okay, so with us, okay, Tony asked any opinion on Ascendas India Trust. Okay, so I just want to explain to you, Ascendas India Trust is not a REIT. It's a business trust. Okay, and business trust does not have the kind of regulations that we have in REITs. Okay, they don't have gearing ratio, limitations. Okay, they don't have dividend payout policy. They actually self-impose those business trusts. I'm not a fan of business trusts because a lot of business trusts that is listed so far have delivered different performance of what we are seeing in the REITs. Okay, look, the REITs that I showed you earlier on, majority of them are green, and then some of them are red. For business trust, I think majority of them are red, and then minorities are greens. Okay, so I generally avoid business trust. Okay, and last questions before we call this off. Okay, how are US REITs compared to Singapore REITs? And of course, US REITs, there's only one or two, Keppel KBS and Manulife REITs. I think you are referring to those REITs that are listed in US versus those REITs that are listed in Singapore. Of course, those that are listed in the US, you have mortgage REITs. There are many types of REITs there. You have equity REITs. That's what we are seeing here with their mortgage REITs in the US. Generally, for US REITs, because it's very far, the difference is that you may not be very familiar with those assets, so you may not be very comfortable. And of course, the yield that US REITs are actually paying is slightly lower as compared to Singapore REITs. So if you're just looking from the yield perspective, I think Singapore REITs is actually much more attractive, and you don't have to take on currency risk. Okay, so that is actually a big thing, especially if you're based in Singapore or Malaysia. Okay, so Malaysia, and a lot of Malaysians that I know that actually invest in Singapore as well. But if you're Singaporean, if you're thinking whether to invest in Malaysia REITs, of course the answer is no, unless the REITs market in Malaysia collapse. Okay, for now it's clearly a no, because there's a currency risk for ringgit to actually depreciate against Sing dollar. Okay, that's actually what happened over the years. Okay, so so these are the questions that you all have, and I think there are so many more questions that I can't answer all of them to you. Okay, but do join us again for the next webinar. Okay, and I just want to remind everyone again before I end this off, we are going to launch dividend machines again this year in 2019. This coming Monday. So if you have anyone who want to join dividend machine, learn how to find income stock and build a multiple stream of income, either through income stocks or REITs. Okay, this is really a good course to consider. I will be personally conducting this workshop together with Victor, and when you join this workshop, of course you're going to you can actually do the learning online and stuff like that. Okay, so look out for our email, and I'll hope to see you at the workshop. And thank you so much for watching tonight's webinar, and happy Valentine's Day. Have a very good night. Rest.